You open your car insurance renewal and the premium has jumped again. But the real decision is not just which insurer is cheapest. It is whether you are quietly paying extra every year for a low excess you almost never use. Most of us treat car insurance like a yearly annoyance. The email arrives, we grumble, maybe we compare one or two quotes, then we pay and move on. But the policy setting that can change the result is often sitting right there in plain sight, the excess. Your premium is certain. You pay it whether anything happens or not. Your excess is conditional. You only pay it when you make a claim that triggers it. So the question becomes, how much guaranteed money are you paying to avoid a possible future payment? The excess is the amount you contribute when a covered claim is made before the insurer pays the rest. A lower excess feels safer because the claim day bill is smaller. A higher excess feels riskier because you carry more of the first hit yourself. In Victoria, the injury cover attached to registration is a separate compulsory system through the transport accident charge. That is not the same as comprehensive car insurance. The excess decision we are talking about is the voluntary policy that protects your car and other people's property. This is why two drivers can need different answers. A careful, experienced driver with no recent at-fault claims is not in the same position as someone who has claimed twice recently, parks in tight streets daily, or shares the car with a brand-new driver. In our own household, the deliberate choice has been a higher excess and a lower annual premium. Not because it sounds clever. Because over a long period with no at-fault claims, the premium savings stayed in our pocket instead of drifting away every renewal. Over 10 years, a saving of roughly $350 a year adds up to about $3,500. That is not a magic trick. It is just one policy setting held consistently, with no at-fault claims during that period. The break-even idea is the heart of it. If raising the excess saves you money each year, ask how many claim-free years it takes before those savings outweigh the extra excess you accepted. For many experienced drivers, that point can arrive surprisingly quickly. But this is the part you must not skip. A high excess is only sensible if you can pay it today without financial stress. If the claim would go on a credit card, break the rent budget, or drain an emergency fund you cannot rebuild, the excess is too high. So here is the midpoint question. Are you buying financial protection or are you buying emotional comfort? Both are real. But if the comfort is costing you every year and you still would avoid claiming for small damage, your excess may be set for the wrong fear. This is a common trap. People pay for a low excess, then avoid claiming because they do not want to affect their no-claim discount or future premiums. That means they are paying extra for a benefit they are reluctant to use. Payment frequency is the other quiet leak. Monthly feels easier because the bill is smaller each time. But many policies cost more when paid by installments. You are often paying for convenience, not extra cover. The workaround is simple. Save monthly into your own account, then pay the insurer annually at renewal. You keep control of the cash during the year, and you avoid turning a predictable bill into a more expensive installment plan. Cover type matters too. Third-party property is mainly about damage you cause to other people's vehicles or property. Fire and theft adds some protection for your own car. Comprehensive goes further and covers your car as well, subject to the policy terms. For an older, low-value car, comprehensive can become harder to justify. If the car's market value is getting close to the next few years of premiums, you may be overinsuring. The right answer depends on the car, your savings, and whether replacing it would hurt. Renewal inertia is expensive. Insurers know many customers stay because changing feels annoying. That does not mean every renewal is unfair, but it does mean the renewal price should be treated as an opening offer, not the final word. When comparing, do it like for like. Match the excess covered drivers agreed or market value windscreen cover higher car rules and exclusions. The cheapest premium can hide a weaker policy. The goal is not cheap at any cost. It is good cover at a fair price. Young drivers can change the calculation completely. Some policies add age excesses, unnamed driver excesses, or restrictions that matter at claim time. If teenagers, learners, visitors, or housemates drive the car, read that section before celebrating a cheaper quote. Your suburban parking situation matter too. Garage parking, street parking, theft risk, traffic density, and repair costs all feed into pricing. A Melbourne driver near busy streets may see a different premium from a regional driver with the same car. The honest mirror is claim history. If you have made multiple at-fault claims recently, a lower excess may genuinely suit you. If you have gone years without claiming and you have the cash buffer, the higher excess deserves a serious look. Before renewal, run the checklist. What is the current premium? What happens if you raise the excess? Can you pay that excess tomorrow? Are you paying monthly? Have you compared like-for-like quotes? And has your car value changed enough to rethink the cover type? Here is the practical rule. If you cannot comfortably self-fund the excess, keep it lower. If you can fund it, have a low claim history and would not claim for small damage anyway, a higher excess can be a sensible way to reduce the guaranteed annual cost. The saving is not glamorous. It will not feel like winning money. It will feel like the renewal being slightly less painful year after year. But those quiet household decisions matter, especially when every other car cost keeps nudging upward. So do not choose your car insurance excess by fear, habit, or the default setting. Choose it by cash buffer, claim history, car value, and whether the premium saving is worth the risk you are taking on. That is the grown-up version of shopping around. At your next renewal, do one extra thing before paying. Change the excess option and see what happens to the annual price. That one setting may tell you more than another hour scrolling comparison sites. Full examples and the 10-year maths are in the article below.